This afternoon we're going to talk about financial management. Financial management is really an essential skill for an effective manager, because that's really what we're dealing with when we are dealing with finances, is that we are managing those finances, and we're wanting to maximize revenue, but at the same time we want to minimize expenses. So this means that when we look at the difference between income and expenses, we have as large a contribution to margin is one term that's used. Another is excess of income over expenses. And another term is profit. All kind of mean the same thing. I think that we can probably relate to the term profit better than any of the other two terms. The second of the global understanding is that if you are successful in financial management, you're going to be pretty well successful in all aspects of the management of your department. What I'd like for you to do is to imagine a canal or a water system of some kind. And that water system has an input. You can think of that as money coming into a system. And that money flows through the system. And at the outside, at the very end, where this water is going to be collected, we want to make certain that there have not been any leaks or places where water has escaped from the system. So if you have a water system at home, which you do, and so when you turn on the faucet, water comes out, and when you turn off the faucet, the water stays in. But if you have a leak in the system, and you have drip, 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 or gushing water where you don't have any control, you can't stop it. To me, this is what financial management is all about, is monitoring all of the places where the money comes in and making certain that none of it spills over and is going to create a problem. Let me give you an example. You purchase food and you put it into storeroom, and then you remove it and you prepare the meal and you serve that meal. When money or product is taken from the warehouse, the storeroom, and not used to make the meal, that product, that money is wasted. It's just gone away. If we prepare something and the cook prepares it and they have burned it, it stayed in the oven too long, we have to throw it away. That is exactly the same thing as throwing away money. And so it impacts your financial management. It impacts the amount of profit that you're going to make. One other comment. When you are serving food to patients or to guests in the cafeteria, part of the standards that we have are, what is the portion size? Remember, we were talking about a standardized recipe. And associated with the standardized recipe is a standard portion. And so if we do not follow that standard portion in providing meal to our patients or to our guest, and we may be giving more food to the patient and to the guest than what we had planned. So the cost of that food that we're giving to them is going to increase because we're giving them more than what they paid for. or more than the money that we have received to provide meals for that patient. So that's why I believe that we need to follow standards. We need to follow the standardized recipe and the appropriate portion size. One other example. You go to a restaurant and you and a friend pay exactly the same amount for that dessert that you have been waiting for. You're just anxious for that dessert. You get a very small portion and your friend gets a big portion. Are you going to be happy?
For him.
I'm not. I'm not either. And so that's another reason why we want to follow a standard portion, so that everyone is getting about the same number of grams. I have a question. When I go to a restaurant here in Romania, and in Europe for that matter, the menu has a number of grams of that portion. Is that portion actually weighed before it's given to me? Yeah, I don't know either. I'll have to find out. We can do that. Good.
The inspector will find out. Sometimes they have inspection.
Yeah, that's true. Mm-hmm. I would like to introduce you briefly to accounting. Have any of you had a class in accounting? We'll do a little bit of review then as well. But there are some important principles that I think that we need to understand in order to be good financial managers. The first one is the concept of the business entity. I'm going to use a similar example throughout this. And let's say, for example, that you have inherited $1 million lei. Okay? Would that be okay? Okay. And so you decide that you're going to invest this money in a business. And you are going to begin a service where you're providing nutrition counseling for the public. Okay? And so one of the things that we want to do is to use this as a source of revenue. Is it appropriate, once the business is going and you have a steady income, that you just remove from your accounts, the money box that you have where all this money is being accumulated? Is it all right for you to pick up that money? It's your money. To pick it up and go buy an automobile?
Buy what?
An automobile? A car? No? It's your money.
It is our profit, or we must share it with the company.
Okay. That's the principle that we want to follow. That the business, the accounts that are established for the business must contain records of everything, of the money that has been received and the money that has been spent with that, or the things that have been purchased with that money. So when you take money out of the business for personal use, you are not recording well what is happening as far as the business. And so you need to keep your personal and your business accounts separate. That's the principle here, is that the business is separate from the person. The financial records of the owner are separate from the financial records of the business. Any questions about that? Okay, you have that 1 million lei that you have just inherited. And the way in which that is going to be recorded in the financial books is that we're going to call that money assets. All right? So we now have 1 million lei. And that is also owner's equity. That is how much value I have in cash at this point. And I don't have any liabilities, and that is obligations or bills that I have to pay. But again, we're going to go into business in doing nutrition counseling. And so before I open my business, I'm going to invest in a computer, and I'm going to invest in a printer, and maybe even a color printer to prepare materials for my clients that come. I'm going to buy some furniture. So what I have done is that I have exchanged cash for something of value. And so the fundamental equation remains exactly the same. It hasn't changed. All we have done is taken cash and put it into something of equal value. And so that is going to be recorded in this balance sheet, and we would refer to it as assets. And we would use those assets then to generate more cash. Now, some of the items that I've purchased, I did not pay cash immediately for it. I put it on an account. I said I will pay for it at the end of the month. And so what I have done is established a liability account that says that I owe you money for what I purchased from you. And at the end of the month, or the time that we agreed upon that I would pay, I will pay. And so that liability then goes away because I have paid that account. Now, you come to me for nutrition counseling, and you tell me that I will pay you on the 10th of the month. And so I record today that I gave nutrition counseling to you, and that you owe, I got mixed up as to who's who here, but I have established an obligation to pay you. And so in my accounts, which is an accounts payable, that says that I owe so much money to you on the 10th of March. And so these are all elements that are going to be found in this fundamental equation. But what it's doing is showing how we have changed the value of that original 100,000 lei that we started with. That's what we're really looking at in this balance sheet. And the objective is to get the value of the organization to increase. It doesn't tell us anything about whether we made profit or loss this month. It just tells us what the changes have been in terms of the original investment that we had. But now the next basic accounting principle is the going concern concept. We can begin the business. We're partners in this business. And we say, we can establish the business, but our intent is to close it within 3 or 4 months. Why would we do that? We don't want to do that.
Why begin?
We may use it for fraudulent purposes, maybe, to, I won't give you any ideas, and I won't get any ideas for myself. But what we're wanting to do in our basic assumption of our business is that we are intending that it's going to continue for a long time, into the foreseeable future. Centuries, maybe, with our children and grandchildren and great-grandchildren. Okay, so it's going to go into the future for an indefinite amount of time. The next principle is that we're going to use money as the medium of exchange. Now, that's not too difficult a concept, I don't think. The other approach that we could take is that we would go into a barter system. Do you know what that is?
Yes.
Yeah. The others of you know what a barter system is? I have these goods, and so you have something I want. You want what I have, and so we'll exchange. No money has changed hands. We're both happy, but in terms of a business, we're going to use money as the basis of recording what has happened. Now, I have a sister, and her husband is a dentist, and they serve in an area of the United States that's very poor. And they will operate their business, part of their business, on the basis of barter, exchange. And so I will, the dentist will say, I will take care of that cavity if you will do this service for me. So in terms of recording what has happened, the value of that service, both services, the dentistry as well as the service that the patient is going to give, we've got to probably assume that both of those have equal value because no additional money has changed hands. So it's possible to do bartering, but we've got to record it in terms of the fact that maybe actual money did flow, but we're just looking at the value of the service rather than the actual money that was there. The next one is the cost principle, and that cost is recorded in terms of money that is gained or lost in a transaction. So the example that I was just giving in terms of bartering, we're assuming that the value of each of the commodities or services is equal. But if it's not equal, then there's got to be a flow of money so that it is equal. And so everything has a cost in terms of the operation. It may be a cost as it relates to the cost of labor or the cost of food or the cost of occupying space, or it might be what we could refer to as a negative cost or money that is coming in. We would call it income. But there is a cost. And a bit later we're going to talk about various types of costs. Cash versus accrual basis in accounting. When I sit down at the end, sometime during the month, to pay bills, I look at how much money I have available, and I look at this list of bills that I have to pay. And so ideally, the amount of money I have available and the amount of money that I need to pay these bills is going to be the same. The style of management that I'm using in this case is referred to as cash accounting. I look at the amount of money I have, the amount of expenses I have, and try to balance those out. Some of the bills I may have to wait till next month to pay, but I will pay them, and I will record everything that I have done. On the other hand, accrual accounting is typically the way accounting is done in business and would be done in a food service in a hospital setting. And the difference is that when a service is given, it is recorded as being given today. And if there is money that came in, I would record that as income for March 1. If the service was provided but there was no money that was given, that is, accounts payable was established, or accounts receivable from my point of view in the operation, that is, on the 1st of March, I established an obligation that the patient will pay me on the 15th of March. And so that says that I am expecting to be paid for what I did today, but I won't really realize that until a little bit later. Another aspect of accrual accounting is, I think, the next item that we're going to talk about, and that is matching revenues and expenses. So this is the example that I have just given is an example of accrual accounting, but it is also an example of matching revenues and expenses, because today's a very good day as the 1st of March, because it's a good day to give examples. I purchased food yesterday, and I recognize the fact that I purchased that food yesterday, but I didn't use it until today. So from an accounting point of view, I paid it on February 29, but I use it on March 1. So I'm going to record the fact that I have used a quantity of food, stated in terms of money, on the 1st of March, even though I received it yesterday or 2 weeks ago. And so that is the principle that we're trying to look at in terms of revenue, and then also in terms of expenses. So revenue that comes in today, I recognize as revenue today, and expenses that I have, that's why I need to have an inventory system that will tell me what the cost is for the food that I use today. I need to know what the cost of labor is today so that I can meet this principle of matching revenues and expenses. There's another example that I would give to you in terms of this model, and that is in hospital food service, we do not receive any income in our hospital for meals provided to the patient. Do you like that idea? I don't. I do all of this work, but I don't get any money. The reason is this very accounting principle, in that expenses and income must be shown on the same account. And so if we are looking at an income and expense statement for a hospital, the income that comes in for caring for a patient has to be balanced with the cost of nursing, of food and dietitians and everything else that goes into the providing of care for a patient. And so those costs for providing food are taken from me by medical center accounting and transferred to the patient unit where the money actually comes in. So it's a little bit different way of thinking about it. And when you really stop and analyze it, it's maybe not such a bad idea after all. I need to be accountable for how I use that money as far as the patient food service is concerned. But in the end, those expenses are going to be taken away from me and given to the patient unit. So that's matching income and expenses. The next one is depreciation. Let's go back to our system, not our system, but our business where we're doing nutrition counseling. And remember all of that equipment that we bought? If you were to sell that equipment, that desk, that computer, and so on, would you get exactly the same amount of money when you sold it as when you purchased it? No. It has lost value. And so we need to take into account that lost value. And there are several ways in which we can do that. But in any event, it's called depreciation. That is, the value of the asset has decreased. Let's take a desk, for example. we pay 2,500 units of money. And we have decided that that desk is going to last us. It's going to provide a serviceable piece of equipment for 10 years. Okay? In 10 years, we're going to experience 120 months. 12 times 10. 120 months. And so what we could do then is to divide that 2,500 by 12. And so we're going to get about 200 and something lei that we're going to recognize each month as the loss in value. We have consumed that value of the product, of the desk. And so at the end of the 10 years, we're going to say, you know, this desk is still pretty good, but we no longer have to recognize the fact that it has value. As far as its value on the books of our business, it doesn't have any value. And so we don't have to pay for it anymore. Now, one of the things that we can do is that we can put into a separate account that we would refer to as depreciation. And so this money, this 200 lei plus that we get every month, we will take that money and we will put it into this account. And so when we need to buy new equipment, we have resources available to us to pay for that equipment. So in terms of payment, that's one thing. But actually recording the value used month in and month out, that's going to be done in a depreciation schedule that is going to be used to reduce its value, this new value of the product that you have just purchased. Now we can modify this process just a little bit, and we can subtract any residual value that the desk has at the end of the 10 years. So if we think that it's going to have a value of 1,000 lei, 25,000 minus 1,000 is going to be 24,000 lei. And then the amount that we're going to recognize each month is going to be exactly 24,000 divided by 120, which is going to be 200 lei per month. Then again, at the end of the 10 years, you know, it has that value, but we're not going to depreciate it any further. Any questions about that? Do you understand anything about depreciation? Yes. Okay. We could go a little bit further, but I don't think we're going to do that. The next is adequate disclosure. As a principle, the statement is that the financial statements must contain full information regarding the operation of the department. So this kind of goes back to the example that we were talking about, that you take money out of your receipts from cash in your business and you use it for personal things. You have not really recorded everything that has happened, and it will make a difference. Now, if you had to pay tax on the amount of income that you have gotten, and you don't record everything that you have received, and you do it for other things, you use that money for other things, that is really unethical. And so you are cheating the government. And so if you are found out, which they can find you out, you're going to be in some serious trouble. So anyway, adequate disclosure is going to assure that we get records of everything that is happening within our organization. The next principle is that of consistency. When we start our business, we have made a decision as to the type of accounting system that we're going to use. We're going to use a cash accounting system, which we can, or we can use an accrual accounting system, which we probably should. But the consistency principle is going to say, once we've made that decision, we need to stay with that decision and not change back and forth. This is particularly important from the point of view that we want to compare one month with another month. And if we're changing variables, changing accounting methodologies, we no longer can do that comparison. And that's, I think, important that we do that comparison. Materiality. Does it really make any difference whether or not we record a transaction? Let me give you a very simple, unreasonable example. I moved into my office 27 years ago. And one of the things that I got for my office was a stapler. And I think we may have paid $5 for it. Is it important that we record the value of that stapler each month, how much value I have used of that stapler? Is it going to make any difference to the bottom line? Not really. It's going to create a lot of work on the part of someone to do all of that mathematics that's going to be required. So, one of the ways in which we deal with materiality is to say that any product that we buy, anything that we use in our business, like in the U.S., anything under $2,500, we don't have to depreciate. It is just, it appears on our statement as having all been spent in the current month. Even though it has value for many months to come, it's not going to be recorded by depreciation because it really doesn't cost all that much money. And it's not worth doing all the analysis. And it's not going to make a difference in terms of decisions that are made. It's not going to make a difference to a rational person who is dealing with this information. We're getting down toward the end of this, and then this one is conservatism. Accountants are very conservative people, maybe to an extreme. So one of the accounts that they will often set up is called bad debts. This is money that you're owed, but you're never able to collect on that. And so they make allowances for that so that the amount of money that you are projecting as far as you're going to make is going to be a very conservative estimate, a very conservative projection of profit, so that you're not disappointed at the end of the fiscal year that you haven't made as much money as what you thought you had because some of the people that owe you money did not pay you. And so the accountant, being the conservative person that they are, is making allowance for this at the very beginning rather than wringing their hands at the end of the year saying, what shall we do? They have already planned what they're going to do with that situation. Hello. That is the end of the basic concepts of accounting. Two more things, though, that we need to talk a little bit about, and that's basic financial statements. Financial statements are recognition of what is happening within the organization. So when we were talking about that fundamental equation, I used the term balance sheet, and the balance sheet is going to tell us the change in value of our original investment. So it's the current report of what the value of the organizational assets are at this time. The next one is an income statement. An income statement is going to look at the amount of income that has been generated and the amount of expenses associated with generating that income. The ideal, what's necessary for us, is that we have more money in income than we have spent in preparing that and making that income, so that we have a profit. And so the income and expense statement is going to report that to us. It doesn't say anything about the value of the organization, but it's just looking at 1 month and saying what has happened financially in the last month. So, in terms of cash accounting, as we were talking about, the amount of income that we have and the amount of expenses that we have, ideally we're going to have more income than expenses. But it doesn't always turn out that way. Another way in which we can analyze our business is through some ratio analysis. Ratios are looking at the relationship between two variables. And so there are a number of different types of ratios that we can use. But the first one that we will look at is liquidity. How fluid or how liquid is your business? That is really talking about, can I pay my current bills? Do I have enough money that I have generated to pay what I owe? And so an example of this ratio is the current ratio, where I'm looking at current assets and current liabilities. This information comes from the balance sheet, and it comes from the operating statement as well. But when we talk about current assets, we are looking at the value of everything that we have in the business. The desk, the computers, the chairs, everything that we had purchased for our consulting business. And then we're going to look at the amount of cash that we have on hand as well, which is going to be the current assets. And then the current liabilities are the bills that we owe. So if the current assets are greater than the current liability, are we in good shape or bad shape financially? Yeah. Very good. So this is an example of a ratio that would be used in analyzing how well a company is doing financially. Solvency is a little bit different situation, and that is how solvent the organization is related to if things turned really, really bad. Do I have enough assets to pay off all of my bills? And so my total assets is going to be cash and things that I can readily turn into cash. And then looking at the total bills that I have. So in looking at that ratio, I would certainly like to have a number larger than 1 in terms of that ratio as well. Ratio analysis as it looks at activity ratios, things that are happening within the organization. And so one of the things that we were talking about when we talked about purchasing and purchasing of food, we looked at inventory turnover. That is a ratio analysis of some activity. And so inventory turnover is the cost of food that we've used in the month divided by the average inventory. And so the average inventory should be less than the cost of goods sold. And so a number that we would want to see there would be, if we get food 4 times a month, I would like to see it somewhere in the neighborhood of probably somewhere around 4 is where we should be, which is saying that our inventory is being completely consumed 4 times a month. That is saying really that we are very effective in the use of our foods and preparing the menu. Good financial management. Profitability ratio is another kind of ratio. And so an example of that is profit margin. What is our profit for every sale that we make? So if we take the amount of profit that we earned divided by the amount of sales that we've gotten, we'll then see a ratio talking about what our profit margin is. And it's going to be a decimal because profit is going to be less than sales. And so it's going to be 0 point something. And so that is going to be a percentage of our profit, of our profit margin. And then there are operating ratios. We had activity ratios just before this, and activity had to do with things that were happening in the organization. But operating ratios are ratios that we look at after the operation has been done, like the end of February, the 1st of March. So food cost percentage is an example of a ratio analysis where we're looking at the total cost of food divided by the total amount of income that we have received. The number that we have here would range probably from 0.2 to 0.5, a 20% food cost percentage up to a 50% food cost percentage. And in a few minutes I'm going to show you, I hope, clearly what difference these percentages make in terms of the money that we can spend for our operation. Remember we were talking about Las Vegas and the fact that they had a 50% food cost there? Is that good or bad? Well, I want to answer that question in just a little while. Another operating ratio is the number of meals worked per labor hour. Yesterday we were talking about the meals per labor hour for different kinds of food services. And for healthcare, it was about 3.5 meals per labor hour worked. So we can use this operating ratio month in and month out to see how productive our operation has been and whether it's getting better or whether it's getting worse. Okay, I think what we will do is look at our food cost percentage that we were just talking about a moment ago. There we go, okay? First of all, let's talk about the operating ratio food cost percentage. Remember that the food that, come on. The food cost percentage is equal to food cost divided by revenue or income. And if we have a 50% food cost, let's take a look at our operating statement, our income and expense statement. And so we have had in our income for the month of February, we earned 100,000 lei. Now, if 50% food cost says that we have $50,000 that we have, or 50,000 lei that we have spent for food. So this leaves then 50,000 lei to pay for our labor, to pay for all of the other expenses that we have to pay. And so if we have a high labor cost, we've got to keep this in balance. We only have $50,000 to cover everything else because we had $100,000 that we started with. So a 50% food cost is not giving us very much money to spend for everything else. It's going to be a very bare bones kind of an operation. Very inexpensive food, not much variety, not a lot of happiness in terms of the meal. But now let's look at the other extreme. Let's look at a 20% food cost percent. So we had the same amount of revenue, but now we have spent $20,000 for food. That's what the 20,000 or the 20% food cost is saying, that 20% of our sales is used for food. So what does that do for us in terms of labor, in terms of other things that we can do to really make the restaurant or our food service just a very, very fine place to eat? So the lower the food cost, the more money you have for extras. And so this is what you're going to see in a very high-end kind of a restaurant. They tend to have a very low food cost percentage. And so they can spend more money for food, and they can have higher quality food. So in hospital food service, we are running somewhere in the neighborhood of 35 to 40% food cost percentage. So 335,000 lei for every 100,000 that we earn could be spent then for food. The next item on our slide is looking at determination of the minimum selling price for a food item. We will go through this process and then we'll apply it to a situation like we started out with in a business, and how much are we going to charge our customers, our clients, for nutrition counseling. Is that important to know? I think so. Okay. There are two things that we need to know before we can calculate that minimum selling price. The first thing that we need to know is what the food cost percentage actually is. And so let's assume it is 0.4 or 40%. The other thing that we need to look at, well, one other comment that I'd like to make, and that is that 40% is telling us what value that food is in terms of all of the expenses that we have in our operation. The cost of food, the cost of labor, the cost of printing menus, the cost of everything that we do. It has to be 40% of that total. So let's say, for example, that we purchase a food item that costs 10 lei. So our minimum price is going to equal 10 divided by 0.4, where 10 is the food cost and 0.4 is the food cost percentage. So the food cost percentage is going to be fairly steady. It's not going to change much. And so we could look at our budget and tell what our food cost percentage is. But if we divide 10 lei by 0.4, what is the minimum selling price for that food product? It's going to be 25 lei. Okay? 10 divided by 0.4. And so that is going to be the minimum price we're going to sell. Can we increase the price? We could, depending upon what our competition is selling that same product for. If we have a restaurant and this item is sold in another restaurant for 40 lei, is that possible? Something very unique and something very good. It only costs us, we need to receive at least 25 lei in order to cover all of our cost. Would you be tempted just to sell it for 25, or would you be tempted to go up and meet the price of what the competition is selling it for? Somewhere in between? Yeah. Okay. Remember what we were talking about as far as goat's milk? Remember us talking about that? Mm-hmm. Okay. If we price it too low, it's perceived by the customer as being not a very good product. But what you want to do is to get as many people to buy that product as possible. And so that's what I hear your strategy being, is that you want to be a little bit lower than the competition so that they will come to you to buy rather than buying from someone else. Not a bad strategy at all. Okay. So if I were to give you a problem which said that you can purchase a food item for 5 lei and you have a 40% food cost, what is the minimum selling price that you sell it for? 5 divided by 0.4. So 5 divided by 4 is 1.25. So 12.5 lei would be the amount of your minimum price that you would sell for that. Okay. That process is useful for food, but let's look at it from another point of view. You want to know what the amount of revenue that you need to get for our counseling business, okay? And so we don't deal with food. We deal with the cost of providing services to our clients. And so we need to then look at the labor cost percentage as being probably the most important aspect of it. And so let's say that our labor cost is going to equal 75%. So 75% of our revenue is going to go to cover labor cost. 25% is going to go to cover all other costs. The cost of occupying space, the cost associated with the equipment and so on that we bought. What is the cost of labor. What do you earn per hour? What would be a number that just any number? 150?
150.
Yeah, 150. All right. And so our cost of labor is 150, and we're going to divide that by 0.75 because that is our labor cost percentage. So 150 divided by 0.75 is going to be, and the answer is? Yeah. 200? Okay. So that is the minimum price that you need to charge so that you can cover all of your costs. Okay. Now, is that going to attract customers to you? Are they going to pay that much? So what you've got to do then is to maybe make some changes in terms of your expenses, what I refer to as the cost structure of the organization. And I would like to take a look at that now. Because what we're going to do is to look at the concept of break-even analysis. Have you ever heard of that before? Do you know what that is? This is a very powerful tool in financial management. The break-even point is the point at which revenue equals income. No. Where revenue equals expenses. Revenue and income are the same. So what I would like to do is to show you graphically what that means. Okay? So we have a graph. This is going to represent lay. This is going to represent volume, number of meals served, for example. Cost may be categorized into two types, at least two types. One type is referred to as a fixed cost. The cost is fixed irrespective of the number of meals that you serve. An example of that would be the cost associated with occupying the kitchen. How much do you have to pay for your kitchen space? And so that would be represented on our graph by a straight horizontal line. And so this is fixed cost. I'm going to erase this now, and we'll come back and put it on again in just a minute. The other kind of cost that we have is a variable cost. And that cost varies directly with volume. And so as volume increases, the cost is going to increase. Okay? An example of that would be the cost of food. As the number of meals increases, the cost of food per meal is going to increase for every meal that you serve. And so it's going to look like a straight line, beginning at the origin down here and increasing at a slope that represents the amount of money per meal that you are spending for that food. All right, so this is a variable cost. So we've had fixed cost and variable cost. Now we're going to erase that, and we're going to put both of them back on the scale again. So here is our fixed cost. Now, our variable cost, remember, started at the origin. But what I'm wanting to represent is not fixed cost or variable cost. I'm wanting to know what the total cost is. And total cost is the sum of fixed cost and variable cost. And so that means that my total cost is going to begin at the point at which the fixed cost line on the x-axis intersects the y-axis. And so I'm going to then get a line like that that is going to represent total cost. That's where we are. Now, the other thing that we need to look at is what is my total revenue? Now, total revenue is going to start down here at the origin again, and it is going to increase at a slope representing the amount of money that we get per meal that we serve. And I'm expecting that the amount of money that we earn is going to be greater than the amount of money that we spend in providing that food. It's kind of do that way. It must do that. And so it's going to be a line that looks something like this. And so this is revenue. Break even is the point at which revenue equals total cost. So where those lines cross, right there, excuse me, is the break-even point. And we can drop a line right down to the x-axis, and so this is going to be the break-even point. That is the volume necessary for revenue to equal expenses. So this, let's go to another color. This area right here is going to represent then loss. This is money that we haven't, it's not doing what we need to do. I don't know. But this area right here represents profit. So one of the questions that we need to ask ourselves is there enough capacity in our operation? Can we produce the number of meals necessary to get to this point right here, to our break-even point? If we can't, what we've got to do is to change our cost structure of the organization. And so when I talk about cost structure, I'm talking about the fact that we need to change our fixed cost and our total cost lines. And so maybe one of the things that we would do would be to reduce our fixed cost. And another thing that we might do would be to reduce our variable cost. What happened to our break-even point? Our break-even point is right here. And so this is our new break-even point. So it has been shifted to the left. That means we need less volume in order to break even. So we have changed our financial structure. We have changed the amount of money that's necessary to operate. And that's what a lot of businesses are doing, is that they are changing their cost structure so that they can be more profitable. Any questions about that? What I have shown you is the graphical approach to break-even point. Let's look at it mathematically. It's maybe even easier than the graphic. Remember that by definition, the break-even is equal to the point at which revenue is equal to total cost. Now, revenue is going to equal then fixed cost plus variable cost. Revenue is going to equal income per unit, average income per meal, in other words, times the number of meals that I serve. Fixed costs remain the same. They don't change with volume. And then variable cost is equal to the cost per unit times the number of units. No. So, to rewrite this, revenue is going to be income per unit, and I'm just going to write a U for unit, times the number of units is going to equal fixed cost plus the variable cost per unit times the number of units. Understand my shorthand? So, break even then is going to be, let's put some numbers to this. For every meal that I serve, I receive, let's say, 12 lei, and I multiply that times units. And that's going to equal my fixed cost. And let's say every month my fixed cost is 75,000 lei, plus my variable cost is going to be 5 lei times units, the number of units sold. So we have 12 units as income and we have 5 units as expenses. So 12 minus 5, well, I'm going to do 12 minus 5 lei times units is going to equal 75,000 lei. So 12 minus 5 is 7 lei, and the number of units is going U. So I could say 7U is equal to 75,000 lei. And so I'm going to solve for the volume. So 75 divided by 7 is going to be about 10.7, not 10.7, about 10,000 meals. I just rounded it out there. So my break-even volume is about 10,000 meals. Now again, I need to ask you a question. Can you serve 10,000 meals in a month? So you need to go to your records to find out how many meals are you serving. You're probably serving more than that. And so your break even is going to, in terms of our overall graph, that's where our break even is going to be, right here. With our cost and our income, we know exactly where we are as far as the volume that we need to have. Your profitability in the long run is going to be dependent upon how much more capacity, how many more meals can you produce. And if you can produce a lot more like this, you have potential for a great deal more income. And that's kind of what we really want. Break-even analysis. You understand that? Anything that you can... It's a very simple concept, but it is probably one of the most powerful concepts in financial management that I think that we really need to look at from a professional point of view.